Good evening, everybody. It is Friday, January 14th, and week 2 of the trading market is officially in the books. And do we ever have a lot to discuss tonight? And before we jump into the charts here, discussing the NASDAQ, there's a couple things I want to touch on in this video. We're going to discuss the news of inflation, interest rates, the banks reported, or some of the banks reported earnings today, oil, the S&P 500, of course Bitcoin has to be touched on as well, crude oil, and a couple of individual picks and price action that we took part in today's markets. So touching on the NASDAQ, I just want to start off with the NASDAQ because it is critical to discuss what the NASDAQ has been going through. So since 2009, the NASDAQ has not had this bad of a start to the new year. And that is saying something. Tech has been the rage for the last decade, and no doubt in my mind it's going to continue to be a valid and thorough investment over the long term, but I do think the short term is in for some chop and volatility and downside pressure. So let's touch on the NASDAQ here. What price action did we see today? Let's actually just go to the intraday chart here just so we can discuss some of this price action. And essentially what we saw in the NASDAQ here was, this is where we opened. We gapped lower, price sold off, made a new low on intraday basis, rallied up, took out the open up here, and then sold off, came below that open again, rallied up above the open price, sold back down below the open price. And this was the critical part that was the bulls and the bears were fighting over. So you were making a series of lower highs here and a series of lower lows, and essentially this was the line in the sand that you needed to hold, because if you didn't start reversing here, you would have likely tested this low and potentially flushed down to it or past it. But you rallied above and you pretty much basically closed positive on the day, which is pretty incredible since the fact that the market was very weak early on and there was lots of selling and downside pressure. That being said, you just took out the high of the day here on a closing basis with a new high. But let's go back to the daily chart here just to quickly sum things up. The NASDAQ right now is making a series of lower highs. There's still your pivot high that is well in effect. Here's another lower high. One could argue that this is another lower high. And this is a series of lower lows. Here we go on the charts. So that's very critical to understand, okay? You're making a series of lower highs and a series of lower lows, which signifies the start of a downtrend or a downtrend, okay? So let's just take these drawings off for a quick second. And I want to drag your attention to this. So what we saw here was a major sell-off and then a big bounce pretty much close to this 200-day. You had lots of support here, but you're trading in between the 50-day moving average and the 200-day moving average. And my opinion is we go lower. The reason I think we're going lower is the fact that there's a major gap fill here on the charts around the 360 mark. That's also, again, lots of major support. You had a pivot low before rally up, and then you had this major price action chop here, and this gap will likely get filled. And it's going to take some time to break the 200 because we haven't seen the NASDAQ break the 200 pretty much since this COVID crash. And this wasn't even a correction. This was a flash crash that we completely negated with the unlimited amounts of QE that we put into the markets. But this pattern is getting weak, in my opinion. You are breaking down. You're starting to test the 50-day moving average. If you notice regarding the last corrections here is you had this W correction here where you broke the 50-day moving average, came up to test it, and then broke it again, and then rallied back up above it. And then you tested it again and rallied back up above it. And then here, same thing. You broke down below it and then had a straight shot rally up above it. So this is pretty much do or die for the NASDAQ. It needs to really rally up above this 50-day moving average and take out this new all-time high, or else there's some major downside ahead. That being said, I do think you come down here to fill this gap at some point, and my suspicions is that tech heavy sector, we have earnings reporting next week, and if the banks are any guide to what happened on earnings, let's just look at JP Morgan here for a quick second. So JP Morgan's reported earnings today, and look what happened. They opened here and they fell massively, gapped lower in pre-market, and then as the market came through, it sold off, made a pivot low. On an intraday basis, we actually played this for a quick day trade, and we entered in right at the 158 mark and sold pretty much at the 160 mark. So we made over $2 on this quick day trade, in and out. And look what happened after we got out. It sold off and made a new lower low. But it did have a small bounce at the end of the day, but nonetheless, it took a beating on the back of earnings. And if we discuss the earnings report, Bank of America actually had to surprise the market with 32 cents per share in earnings, more than what was the estimate was. However, the revenue came in a lot lower. That being said, I think we're going to see strong earnings from the tech companies, but if this Bank of or JP Morgan is any indicator, sorry if I said Bank of America, JP Morgan is any indicator as to what is going on in the markets. Generally, the banks perform exceptionally well with high interest rates. They have a little bit of more alpha when interest rates are going up, whereas tech, when interest rates go up, tech sell off significantly. So even though we may see strong earnings from the tech companies, I suspect we still see some sell action transpire. Let's head to the SPY, the S&P 500. So same thing. It's very similar pattern to the NASDAQ. This index should hold up a little bit better as interest rates rise because it does include a variety of the large cap banks. But nonetheless, I do think you head much lower on this daily chart. And because you're trading under the 50 and in between the two, again, you're still kind of in that no man's land where it could float up. But this is the pivot high you need to watch. This is the line in the sand that if you're short the market, you pretty much want to put your stop loss at just a little bit slightly above that high. You could come up for a double top, but I think it's unlikely. Now there is a bit of a head and shoulders pattern at play here with a left shoulder here, a head. Now the right shoulder, one could argue this is a right shoulder. For me on a technical basis, I like to see the pattern a little more symmetrical. There's roughly 12 days in between the pivot high on the left shoulder, and I want to see basically another 7 days of price action coming up to this pivot high level at the 473 mark to create a nice rounded shoulder before it rolls over and breaks the neckline at this green line. Now, that being said, if we do have a head and shoulders pattern formation form on the daily chart and it breaks, a calculated downside target is right down to this pivot low at the 415 mark where you have major support. You have this pivot low here. You also had a previous pivot high and lots of chop in and around this area. So it's one thing to keep in mind is that a head and shoulders pattern only is concerning if it breaks the neckline. And we just have to wait and see, but I suspect more downside. Looking at crude. Crude is an exceptional chart. Let's just take a look on the daily chart. So if you look at the crude futures, it's almost coming up to this double top region here. So you can actually draw just a little bit of a trend line up there. And this green dotted line would be signifying a double top. Now, there's lots of bullish sentiment around crude. I've been hearing triple digit oil for several weeks now. And the price action is very bullish. That being said, the double top, I will be shorting at that level because you have to respect the double top. However, if you go to the weekly chart and we take a look, these yellow parallel lines, well, they're almost parallel, really connect some key pivot highs here and some key pivot lows. Excluding this COVID crash, which is a black swan one-off event, you still have a major trend line of support there, and you have a major trend line of resistance on the weekly chart. That being said, oil could come up to test this double top and overshoot slightly and come up a few more percent, but I will be shorting in this range because if you look at the risk to reward, every time crude trades within this channel, it gets to the top of the yellow channel, it sells off dramatically. So the risk to reward ratio for me as a trader is second to none. It's very, very lucrative and in favor of a good trade setup. And if you actually draw a trend line from that pivot high to that pivot high, you can see that you still have potentially some more upside bias. Let's just go to the daily chart you could still float up to this blue line or this yellow. I do think the yellow line is going to be your major resistance, and that's where the price action stops, but you could float up there in the short term. So I do suspect slightly a little more upside, but taking a short position here via the SCO would be a very wise move, and adding up here when it gets to this trend line is even a better move. Now, why do I think the markets are selling off? One of my favorite things to analyze is interest rates, the US 10-year. And why am I so fascinated about this chart? Well, recently in the price action of interest rates is you previously had this pivot high here all the way back in March of 2021 that was keeping the markets checked in a range. All these tech companies got used to trading in a market, so it didn't really matter what interest rates did as long as they didn't take out this pivot high. But it's official, people. We have officially taken out this pivot high on the US 10-year. And now, what did we see? Well, what's really interesting about this price action is you had this major breakout in interest rates, as you can see, this falling down sloping trend line. You had a big strong move, basically a 6-day surge to a high, 1, 2, 3, 4, 5, 6. If anyone knows a 6-day time count, then the odds of a pullback were exceptionally high. And what did we see? We saw a beautiful controlled pullback. This is the type of pullback you want to see. It's a very technical pullback. You had basically a 6 days of upside and 3 days of a pullback. So it's a very balanced, bullish pullback. And what's critical about this is this was a key breakout level as well. In October, it was a pivot high. And you broke out of that, and then you pretty much pulled back. You retraced to that original breakout zone. And now you're bouncing off of it. And what's critical about this chart is I was actually watching this intraday, and interest rates were lagging this morning and at the beginning of the trading session, and they powered through near the end of the afternoon trading session. And what's so critical about interest rates not only closing above this blue line, which was the previous pivot high here, now you're set up for confirmation on not Monday but Tuesday when the markets open. You're set up for confirmation. So if interest rates rally up and confirm above this level or this previous high, then it's off to the races for interest rates. And what's so cool about interest rates, I was actually tracking this on the weekly basis. And this candle, so a weekly candle here, which comprises 7 days of data, it was actually red. It was bearish on the day. So I was like, oh my goodness, I hope interest rates don't close on a red candle for the week. And sure enough, what did we get? We saw interest rates rally near the end of the day, and it closed on a weekly basis. You got a massive green candle on a weekly basis. So that is super bullish, really, really bullish for interest rates. You've actually closed right on the 200-day moving average. Look how incredible that is. On the weekly basis, you've closed right on the 200-day. That is exceptional. It can't get any more technical than that. And it's really a beautiful sight to see. And if you actually go back farther, if you look at the high in 2018 here, you have a downsloping trend line, which you've now broken out of. You had your breakout impulse move, which is this huge candle here. You had a little bit of 3 days of consolidation, and then you had a massive bar to the upside to close the week. And you've actually now, on a technical basis, confirmed a breakout of this downsloping trend line. So that is super bullish for interest rates, and that's why I think the tech and over-leveraged sectors will continue to sell off, and the markets will continue to see major downside because interest rates affect so much. I mean, when you have a global debt to GDP ratio that checks in at about 330%, any minuscule increase in interest rates could trigger widespread defaults. You just have to keep that in mind. With the global debt to GDP at 330%, that is astronomically high on a historical basis. And then when you factor in the levels of margin that are being traded, it just blows my mind that this market is still up. But it's still up because of loose policy. But that policy is changing. And if the tightening of policy continues, there's only one direction the markets can go. Of course, there's bounces along the way, but there's only one way the markets can go. Let's take a look at gold. Gold has just been consolidating, and if you notice gold is an asset I love. I'm actually long gold right now. And we haven't seen a clear breakout yet, but gold is one of those assets that is significantly undervalued. It's gone through a major correction. If we just look at it on a weekly basis, on a longer term time frame, gold's actually still trading within this arc pattern that's kept it in check. And you've gone through this major consolidation since August of 2020. It's almost an 18-month consolidation. And I suspect that once you break out in gold here, you're going to see some serious gains here, potentially in the rate of 25% for this year. So that being said, what factors influence gold's price movement? Well, we have one of them already, inflation. With inflation being reported 7% year over year, the highest in 39 years, that checks that box for the macroeconomic factors of gold. What else do we look for in gold? Well, I'll tell you, it's the DXY, the US dollar. And the US dollar has been acting very, very strong as of late. However, it has officially broken out of a rising wedge pattern. And if we start to see more downside in the US dollar, that's when gold is really going to ignite and get its boost. So we have to see the US dollar break down before gold is going to seriously make a run for new all-time highs and to test that all-time high in August. Okay, but once we break out of this downsloping trend line, that's the neckline of the inverse head and shoulders pattern, and we're off to the races. And we'll start seeing some massive movement in gold. And what's really intriguing about this gold chart is this arc. This arc has kept us in check for quite some time now. You had a massive dump here, got close to the arc, rallied back up, got close to the arc, rallied back up, close to the arc, rallied back up. Here, you came really close to the arc, chopped around, pierced and broke the arc, but as soon as you broke the arc, it was like the algorithms and on a technical basis, traders knew they bought the price for action back up. Chopped around, broke the arc only at 1, 2, 3, 4, 5 days ago, and as soon as you broke that arc, you didn't even stay there or close there for a day. You ripped right back up, big reversal candle, engulfed the previous candle, and then rallied all the way back up. And now one can argue that you're making a little bit of a bullish consolidation pattern here, which could point to a breakout to test this high. Once you break out of this pivot high and this neckline, I believe it's off to the races as the US dollar should weaken. Okay, let's take a look at Bitcoin. Bitcoin's a really interesting chart. So Bitcoin, you still have this head and shoulders in effect. And why it's in effect? Okay, so you have this left shoulder here, you have the head here, or this M top, and you have this neckline here connecting the left shoulder pivot low with the right shoulder pivot low, and you broke and you confirm below that. But what's really interesting about this price action is you've rallied up, you pretty much tried negating this this neckline, but then you sold right back down, and now it looks like you're making some sort of bearish consolidation of this overall pattern. So I do suspect more downside in Bitcoin. Bitcoin is an amazing asset to trade on a technical basis. It is so technical. It's one of the most technical assets in terms of bounces and levels. Like just for instance, look at this. I mean, you had this massive sell-off here, and then you bounced. Even if you had bought here, you could have gone long for a swing trade. But then you take a look at where price really dumped out. Boom, pivot low on the left shoulder. Okay, now you're going to have some major support zones coming up, but I do suspect that the downside will continue. As if you look at the price action of Bitcoin relative to the S&P or the NASDAQ, it's had a very similar, over the last several weeks, it's had very similar price action, where the NASDAQ also put in its high back in November, and so did Bitcoin. So Bitcoin put in its high in mid-November, the NASDAQ put in its high in mid-November. How interesting is that, people? The S&P put in its previous high here in January, but it's a lot stronger index because it has banks and it has a few other companies that aren't heavily associated with tech. But just looking at Bitcoin to the NASDAQ, which is tech heavy, and generally tech are the growth earning stocks, the more speculative stocks, and you're betting on a lot of future growth and future earnings. But the fact that this pivot high in mid-November lines up with Bitcoin's pivot high in mid-November is exceptionally interesting and intriguing to me. And the fact that the two are moving in tandem are exceptional. And what's also interesting on Bitcoin chart is look at this. Does anybody know what this is? Where the 50-day moving average slopes down and intersects with the 200-day? That's called the death cross. And the death cross is a well-known technical signal that suggests a lot more downside is ahead. And you're officially entering into that bear market trend. Okay? Let's just take a look when last we saw this death cross. Well, we saw it here, and price action sold off and came down substantially. But I do suspect Bitcoin has a lot more downside. Let's take a look at net. Net's a really interesting play. We managed to pick up a little bit today, right on this pivot high, and I just want to show you why we picked up net. So, despite I still believe tech going down, some names have seriously gone through major corrections. And net, if you take a look at how much net is off of its all-time highs, net is off 57% correction in basically 3 months. That is exceptionally beaten down and oversold. So I do suspect even with rising yields, you have a bounce in net here. And this is why we picked up a small position. We went long right at this white trend line here. And I'll show you why we went long there at that trend line. Not only did you have some major support in here, the real kicker was it was a major previous high at the beginning of the year in 2021 at February. So you had a major pivot high, another pivot high, impulse move candle here. This is your impulse candle that you broke out of this pivot high here. So you had major support on there. And what did we see? We've currently saw a small bounce right now, and I do suspect net goes up a little bit more. Maybe we're looking for about $10 gain on there before we close. This isn't a long-term hold that I'm doing. I do think net goes lower, but for the time being, I think it's so beaten down that you have to get a bounce. And now this is a very intriguing chart because I just want to show you something that is really key and critical to understanding in our markets. So here you notice net has fallen 57% in 57 days. That's basically 1% per day that it's fallen. Now if you take that same previous high and you bring it down all the way to the same level, so roughly 57%, just take a look at the time frame. So this is what I mean when I say stocks take the staircase up but the elevator down. So basically the same percentage move that it took 154 days to the upside, it took that same percentage move on the downside in basically triple the time, in less than triple the time. So that is exceptionally something to understand, that the markets fall so much faster than they rise. That's why people have to be so ready if the markets fall, and I'm afraid that people aren't ready if the markets fall. And really having some short positions if you're all long is critical to protecting and hedging your portfolio, because this is an exceptional drop. 57% in 57 days versus 57% in 154 days. Do you see the point I'm trying to make? The run that it took to get up here was triple the amount of time than what it fell in the same amount. And that's something you have to understand about investing, is the downside action is so lightning quick these days, especially when you have margin levels at all-time highs. That means if there is some sort of liquidity crisis, the stocks will fall so much faster than they have ever risen. And that is something you have to be wary of. Let's take a look at SE. Okay, SE, same thing, just beaten down to a pulp. Oh my goodness. What an incredible sell-off. Look at this sell-off. So again, a 54% sell-off in basically 84 days, so 3 months. Now let's measure that same 84% move. It roughly took 351 days. That's incredible. The same move from basically $170 all the way to $373 took 351 days versus from $370 to $170 took 84 days. So again, the upside move took triple the amount of time than the downside move. You just have to understand that the downside action moves so much faster. And even though this says you've made 120% in 351 days, one would say, Curtis, where's your logic around that? What are you comparing? 120%, I've made more. Well, if you bought in here at 170 and you didn't sell, even though you made 100%, but you weathered the storm and took this whole drop down, you're back in the same place, even though it's only fallen 54% on a percentage basis. You still break even. Even though it says here you made 120%, but it's only fallen 54%, that's something you have to understand about the markets. It takes half the amount on a percentage basis to fall for you to be basically in the same spot. Okay? So that's just incredible, the price action in these specific stocks. One last thing I want to touch on is what we're expecting over the next week and over the next 2 weeks, really. So oil is getting a bit extended. The S&P, you got to watch out for the head and shoulders pattern. The banks reported earnings, a few more to go. They have seen some major downside. Interest rates are slowly starting to tick up. That's one thing you got to keep your eye on over next week. Next week is critical. You have tech earnings. The big players are reporting earnings, and I do suspect strong earnings from a lot of the players, but take the banks as any indicator. They reported strong earnings, and they still declined. And banks typically perform well with rising interest rates. So they have that macroeconomic factor to bolster them and boost their stock price. But yet we saw a sell-off. So if tech earnings report strong earnings, but they're super sensitive to interest rates and rising interest rates, the thesis behind it is that even though they could still report strong earnings, we could see sell-offs in the stock prices. Okay, just factor that in. Now next week we also will get to see, I'm just researching a couple things here. Oh, some of the data sets that we have to watch out for. So on Tuesday we get the manufacturing index comes out, the building permits, the housing starts on Wednesday, job loss claims, and then the Philadelphia Fed manufacturing index and existing home sales on Thursday. So accompanied with tech earnings week next week, as well as tons of economic data, I suspect there's going to be lots of downside, lots of volatility, lots of opportunity. You stay nimble, you stick to your thesis, you stick to the stocks that have been beaten down, the stocks that are overbought, and I suspect you'll do well. Shorting in 2022 is definitely my game plan. I've been taking a lot of short positions as of late, and especially before the new year started, and they have been performing exceptionally well. There's still a few names that I think are overbought, but you have to remember the short positions, they call it a short for a reason. You have to be in it in and out. It's a very short-term trade because the bear market bounces that we experience, once we do go into a bear market, the bear market bounces that we experience are rip your face off kind of bounces. They are some of the most lucrative bounces that you can profit from. And that's why I'm so excited to experience a bear market, because not only do we need it and we need these high growth stocks to correct, there's so much money to be made in a bear market. And plus you'll be able to buy your stocks, your tech darlings on the cheap for a long-term investment thesis. So that's basically all I want to cover for tonight. I hope everyone enjoys their long weekend. Just for instance, the US markets are closed on Monday for Martin Luther King Day. So once again, it is a short week. I do expect double the volatility since it's a short week. A lot of people will be trying to squeeze in profits in a 4-day window instead of 5 days. And then the following week after tech earnings week is yet another big week. We have the Federal Reserve meeting on the 25th and 26th. I believe we hear Jerome Powell speak. So they'll be discussing interest rates, whether or not they tighten faster, whether or not they stop the quantitative easing that we've been experiencing over the last 22 months. And I am pretty much basing my whole thesis around their policy. If they tighten policy and stick to their guns like they say they would, and if they have any sense of credibility and stick to the tightening of policy, the markets are going to go down. And the reason they're going to go down is because if you factor in over the last 22 months a 6% GDP in the USA, that GDP growth, half of that GDP growth, so 3%, has roughly come from artificial liquidity. So if you remove that artificial liquidity over the next 12 to 24 months, technically that GDP should decline by, it should get cut in half to 3%. And if anyone knows anything about basic macroeconomics, if you cut the GDP in half, it's going to be a bloodbath in the stock market and certain assets. On that note, I wish everybody a happy weekend and best of luck next week. Stay tuned.